Good evening, ladies and gentlemen. Thank you for joining us for an interesting discussion on an exciting topic with an inspirational individual. But before we begin, maybe a word of welcome from our CEO, Mr. Faisal Sarkho. Bubadir, will you please?
Thank you, Faisal. Well, good afternoon or good evening to you, wherever you are. We're really pleased to have joiners from all over the world joining our exciting webinar. Really thanking you very much for joining us today, and it is my pleasure to welcome you all. My name is Faisal Sarkho, as mentioned by my colleague, and I am the CEO of Kamco Invest, a Kuwait-headquartered MENA regional powerhouse that is focused on asset management and investment banking. Together with my team, we are committed to the investor community, and we believe in building value knowledge for making wiser investment decisions in an ever-evolving economic and business environment. As part of our ongoing quest to provide our investors with the greatest value ideas and opportunities, we continue to seek, identify, and track the most pertinent trends in markets and how these can affect investment decisions and enhance future investor returns. Today, we focus on areas which have gained wide and significant popularity, specifically the role of digital transformation, artificial intelligence, and automation. Digitization and digital transformation are now a part of the mainstream in our daily lives and are imperative for those wanting to remain competitive in today's evolving world. We as an institution are committed to keep pace with the transformation by evolving with the times and competitive advantages, both through the adoption of the latest internal systems or to deliver best value to our customers, investors, and stakeholders. Even successful businesses or business models have to undergo or continue their digital transformation. Otherwise, they will not grow and may quickly face becoming obsolete. Citing one of my favorite quotes by John Shedd, a ship in harbor is safe, but that is not what ships are built for. We must all continue to set sail and advance or be left behind. On behalf of Kamco Invest, I am honored to welcome Cathie Wood as our esteemed guest today and look forward to hearing her thoughts during this webinar on what she believes are the 5 innovation platforms, namely DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. Now, I know that's a lot, but I'm sure we have a very active session in that. Really, with that, I want to leave the floor first to Tim Lord, and thanking you again for joining our webinar and looking forward to this discussion.
Well, thank you very much, Mr. Faisal, and thank you for those very kind words of introduction. Just very briefly, my name is Tim Lord. I look after the Middle East and Africa for Nikko AM. We're a large financial institution based out of Tokyo with with over 250 billion assets under management for our clients worldwide. We have a long-term expertise and interest in investing in, obviously, all things Asian, Japan, and China. But we also have the great joy of representing some strongly performing, and if Cathie doesn't mind me saying, shiny examples of global investment. We first came across ARK Invest and Cathie Wood's unique and differentiated approach to research and investment in 2016. And since then, we have the great pleasure of having a strategic partnership with her, where we look after distribution for ARK outside of the US. So I just want to thank Cathie personally for coming and doing this particular webinar and this event. And thank you also to my friends at Kamco for their work in setting it up and getting it underway. And with that, I'll pass you to the more interesting stuff. So Faisal and Cathie, maybe I can pass to you at this stage.
Thanks a lot, Tim. Thank you. And now to our guest, Cathie. Thank you for making the time out of your very understandably busy schedule. Also noting that it is currently right in the middle of trading hours in New York. There are many topics that we would like to hear your thoughts on. Most of the attending audience, if not all, are familiar with you and who you are, and all from your admirable engagement with them across numerous platforms through your full transparency. But I thought we would start with who Cathie is prior to ARK. What in your career drove your attention to innovation and consequently your mindset to investing in innovative and disruptive companies? I thought that would be a good stepping stone to start from.
Sure, thank you, Faisal, and also Mr. Faisal. So what started this? My father was an engineer and was an expert in radar systems, which when he was coming of age, that was the big new technology, the next big thing. And so we traveled extensively as my father was going around helping different, mostly Air Force bases with radar systems. And he made sure that as soon as Fortran came about, that I would start programming with that, which of course I hated. It was just like punching cards. But I would say that it started very early on. I think the real impetus for my focus on innovation in the investment world was when I joined Jennison Associates. I was focused on economics, but really wanted to get into the research world. And Sig Segalis, the chief investment officer there, this was in the early 80s, he gave me that opportunity, but I had to find my own universe because the analysts at Jennison were lifers and they were not going to give up their stocks. And so what that gave me a great opportunity to do is when a stock fell through the cracks, and that's an important phrase, when a stock fell through the cracks, meaning database publishing with Reuters and Telerate, it wasn't a database company, it wasn't a publishing company, so those analysts did not want that stock. And I said, I'll take that. And what was that? That was the precursor of the internet. And so I naturally, same thing with cellular technology in the 80s. Not much interest in it, especially not internationally. And so I raised my hand there as well. And of course, we know what has happened in the wireless industry. So this idea of falling through cracks was the earliest manifestation of what we're seeing now turbocharged, and that's the convergence between and among technologies that is creating one S-curve feeding another, and an explosion in innovation. So the 5 platforms, I can give you a very good example of convergence there. Autonomous taxi networks. That combines is the convergence of 3 platforms: robotics, autonomous vehicles, energy storage. They will be electric. That's going to be the most cost-effective form of transportation, and artificial intelligence. These autonomous vehicles will be powered by artificial intelligence. We think this will be a $7 trillion revenue opportunity in 10 years, wow, which is bigger than the energy industry is today, even after this latest price increase. So a huge amount of potential in that space, which is valued at almost nothing right now.
Do you look for opportunities that cross platforms or cross the 5 platforms you mentioned? So if one just falls within energy storage, do you just avoid that? Or do you require a company that has multiple exposures through those 5 platforms?
Well, we're focused on picking the winners in each of the platforms, but the aha moments that come out, especially of our brainstorming session every Friday. So we spend 2 hours brainstorming with all of our analysts and what we call theme developers who are who come in and join that discussion. They have areas of expertise, but usually they're from colleges or venture capital teams, or they're entrepreneurs who are trying to push the frontiers of knowledge forward as fast as possible. So the real aha moments can occur there when we're all together. And just to give you an example, it has been very interesting in the genomic space, which is another area of massive convergence. We think, we have the 5 platforms, but there are 14 technologies involved in those 5 platforms, all of which are moving into exponential growth trajectories. So it's been fascinating to watch our analysts in the genomic space, an expert in DNA sequencing, for example, interact with our artificial intelligence analysts, who's expert in neural networks, which are patterned after the brain. So to watch them interact really does surface some very interesting and exciting aha moments. One of them, and it's been really exciting this week, is around gene editing, CRISPR-Cas9, a huge good news today. We've already had good news evolving that this technology might actually cure diseases, which, you know, the most seasoned healthcare analysts in the industry have not really focused on this because the market caps were so low, it didn't seem worthy of their consideration. But we took the opposite tack from the time we started the firm in 2014 and really became very involved with these companies and learned more about the technology. We were saying, wait a minute, you mean you think this could cure disease? Because effectively what's happening here is we're able, thanks to artificial intelligence and DNA sequencing, we're able now to find the needle in the haystack, which is a mutation in our genome. Our genomes have 6 billion bits of code in there. And it was impossible before the convergence of DNA sequencing and artificial intelligence networks to isolate those mutations. Without DNA sequencing, which is the foundational technology, CRISPR gene editing would not be possible. We needed to find the mutations first so that we could reprogram the genome, which is what CRISPR does, and really reprogram, correct the error that has evolved in the genome so that disease, which mutations are the earliest manifestation of disease, that disease will not progress. So think about a lot of work in this space now on diabetes, which is a very complicated disease. And in the United States, it is the biggest ticket in terms of healthcare, diabetes and related conditions. So it's very exciting.
These have always been chronic diseases, and you've always invested in pharmaceuticals that cover these chronic diseases for the lack of cures. They're always going to be medicines that sick people are always going to be taking. I'm one of them. I'm a type 2 diabetic, and previously I've looked at companies that produce diabetes medication for that specific purpose. I haven't seen somebody that comes up to me and says, hey, I've been cured by diabetes and this is the company that provided the cure. But I think that dynamic has changed right now.
Yes.
But I would like to, on that note, you talk a lot about escape velocity. Mm-hmm. And maybe you can give us put into context, what is escape velocity to you? How do you understand it? Maybe you can explain that to us. And is it pertinent only to small caps, or is it across caps in general? So from small to large caps.
It is relevant from small to large, and I'll give you an example. But escape velocity for us has to do with the learning curves associated with different technologies. Those learning curves are characterized by cost declines. And as costs decline and these companies pass those cost declines along in the form of lower prices, more and more people and businesses, consumers and businesses, are attracted to these technologies because typically they're better, faster, more productive, more creative. And at some point, the costs are low enough that they're going to achieve nearly mass market adoption. So escape velocity for us means that the costs have dropped low enough so that they are unleashing waves of demand from different segments of the marketplace. And we'll see that through market shares. So let's take the market cap question. I think many people, as we went into the coronavirus and we're coming out of it, were very surprised to learn that online retail in the United States was less than 15% of total retail sale. Wow. Because it seemed, I mean, we're getting boxes every day. I mean, I don't go to stores anymore. The coronavirus bumped that up to about 20% in the United States. In China, it's somewhere in the 25 to 30% range. When a market share moves past through 10, 15, and up to 20, then we know we've hit escape velocity, typically. And what that means, and many people, even though I'm saying this, they'll also note that in our flagship fund, we do not own Amazon. And one of the reasons for that is we're looking for the next FANGs. But another reason is because every retailer is throwing as much as possible at online in a way they didn't before. They considered their competitive advantage to be more the experience inside bricks and mortar. Now they understand that world is, I'm not saying it's disappearing, it'll turn into some kind of experiential retail experience, but the convenience and the lower cost and the time savings associated with online are so clear now that everyone is driving towards online. So it's a very well understood trend. We tend to be in those that are less well understood.
Could you give us examples of companies that are experiencing escape velocity in your portfolios across your ETFs?
Well, okay. So I think if you look at just Tesla, which is the largest holding,
okay,
last year out of somewhere in the 80 to 85 million unit range of total electric vehicles sales, total vehicle sales, electric was only 2.2 million. So that's a very small share, less than 3%, right? We can see now that the total cost of ownership of an electric vehicle has dropped below that of gas-powered cars. Now, that is starting to increase the shift or accelerate the shift towards electric. And in fact, last year was a very good test case. I believe electric vehicles sales globally were up 33% in a year that gas-powered vehicle sales were down 10%. So that shift is taking place. And ironically, I never thought COVID would cause this, but as people decided they wanted to avoid mass transit and needed another car, which we don't think is going to last as a phenomenon. But as that happened, the shift towards electric accelerated, especially in China, which is offering subsidies. So the escape velocity in electric vehicles seems to have been forced earlier than normally would be the case by the coronavirus and by subsidies in China. So we think electric vehicles are in that category. You'll see the second largest holding in the flagship fund is Roku. The shift, the escape velocity towards streaming media took place because we were stuck in our homes for almost a year, or maybe more than a year in many cases. So what's been fascinating about this is if you look at television advertising, now this is just a US number that I'm giving you. Television advertising in the US was plateaued at roughly $70 to $75 billion for, I'm going to say almost 5 to nearly 10 years, as television viewing was collapsing, especially in the most attractive demographics, the younger people in the 18 to 36 range who are making consumption decisions for the first time. There's no way the advertising should have been sustained in television that long. Well, COVID has changed that. So the cliff, we likened it to, I don't know if you know the cartoon character Wile E. Coyote. Yeah, Wile E. Coyote is running.
The audience does this all, yeah.
Yeah, the running, and doesn't realize he's off the cliff until he looks down, and then boom. And that's what's happening to television advertising. So COVID helped this idea of escape velocity along much faster than otherwise would have been the case.
And with regards to demographics, you touched upon it with in terms of Roku and online streaming. Demographics are very powerful. When you look at the purchasing power of millennials, for instance, we used to look at baby boomer trends and interests, and now we're looking at millennials. How is that taken into account with regards to identifying the opportunities that you do? Yes, in streaming, but in other sectors, how does that play out?
I think one of the most important strategic moves we made very early on was deciding our analyst team is going to have one foot in the new world. They're either coming straight from school or they're coming out of one of these very interesting opportunities. So our genomics analysts, we have 2 right now. Actually, we're hiring 2 more, believe it or not, because it's probably the most explosive and misunderstood space. But one came directly from school, Johns Hopkins, with a biochemical engineering degree. And the other one came to us from Memorial Sloan Kettering background, where she managed cancer trials and also has a degree in healthcare, but had also worked at IBM in their healthcare artificial intelligence division, and also took a program at MIT. So that's the kind of convergence team we have, even in genomics. So how do we find these ideas? Either our analysts have been educated and have been doing research on them before they come to us, or they've been in industry and they've seen the pain points and the convergences that are necessary in order to make some of these big exponential growth trajectories happen. So I think that's the first. And then the second is our research itself. Our screen for ideas is not any benchmark. In fact, benchmarks are anathema to innovation because they're backwards looking, right? Those companies at the top of these benchmarks are there because of past successes. And in our view, the traditional benchmarks are being populated increasingly by what we call value traps. They're cheap for a reason. They're going to lose or they're going to fail from a market share point of view. And so our research is a white sheet of paper. That's how it starts. Okay, an autonomous vehicle, what is it? And so Tasha Keeney in 2014, 2015 was trying to answer that question. And we find more answers than I expected early on from social media, because and it's most unexpected where in social media. When I first conceived our research ecosystem with social media in mind and crowdsourcing in mind, that was August 2012, when Twitter was for tweens, teens, and celebrities, right? I don't even think politicians were on there yet. And so I really am surprised to learn and watch how that platform has transformed from the tweens, teens, and celebrities to people interested in sharing knowledge, exchanging knowledge, and of course, politicians. And of course, there are others, but the kinds of conversations we're having on Twitter with the innovators, those in the community who are innovating, are astonishing to me, especially in the genomic space. You can follow Simon Barnett on Twitter or Ali Ehrman on Twitter. Just follow their threads. I don't understand half of what they're saying because they're talking to other genomic experts and they're enlightening one another. So I think that combination, where our analysts have come from, the kind of research we're doing, which is a white sheet of paper, and so the ideas present themselves as we're trying to discover what an autonomous vehicle is, and then the innovators themselves who really do love our research. We give our research away for free, not when it's finished, but as it's evolving, because we want these innovators and others skeptics especially, to battle test our ideas. So it's that combination.
And how has that transparency served you? Has it served you well, and how? I think that differentiates ARK and Cathie Wood from the rest of the managers out there, or opportunity providers.
Yes, it's been a huge competitive advantage because most other asset managers will not let their portfolio managers and analysts say anything about what they do and how they're thinking about what they do on any social platform. We are very careful in how we do it. And our chief compliance officer spent 4 years at the SEC as a bank examiner, a bank or an asset manager examiner, when there were evolving guidelines for social media and marketing. So we know we have our marching orders from a regulatory point of view. But it's a huge competitive advantage because we've become a part of the communities that are innovating. And we believe we're the first sharing economy company in the asset management space when it comes to research. And in the sharing economy world, if you don't give, you don't get. So you don't have the rich dialogues that we're enjoying. You can look at our dialogues, and that's good. But I think there's something very powerful in terms of how we are pushing the frontiers of knowledge forward because of the dialogue. It's a very different experience than just watching it.
And in terms of ecosystems, there's been recently a lot of interest in VC and that type of investments. But with regards to ecosystems, we understand that the US is superior in terms of promoting innovation. Are you seeing opportunities across the pond in both directions, whether in Asia or in Europe? Is this something that you're willing to explore and potentially capitalize on early enough?
Absolutely. And what's also fascinating is, some of the US regulators have become somewhat sclerotic. They work very slowly. And that's what happens when any innovative company or country starts resting on its laurels. So what I love around the world is the competition that the US is experiencing from other countries. And I'll give you an example. In 2014-15, when we started doing our work research on drones, which are robots, it's another form of robotics, we started paying a lot of attention to what the Federal Aviation Administration was saying about drones and what they would and would not allow. And we witnessed that Amazon was on its 9th generation drone and asked for permission to be able to fly its own drones, not just inside a building, but outside on its own property. And the FAA said no. And once that happened, we had so many countries around the world saying, hey, Amazon, come here. We will let you. Australia, Hong Kong, India, the UK, and others. I know there were a number of others. And that woke the FAA up. The FAA is still moving slowly. We would prefer much more rapid moves, but they are moving now. In the early days, they were saying, this is not happening for 10 years. And of course, here we are 7 years later, and they've become much more amenable to drones here in the United States. And that's good, but it would not have happened if there weren't the competition from other countries. And I think there are a lot of places in the world who want to attract innovative companies. And I know in the Middle East that there is a big move in this regard, which is, again, terrific, really terrific, because competition makes us all better, and it also makes innovation happen faster.
And in terms of competition, maybe I can bring you back to the point of benchmarks, and I'll tell you where I'm going with that. With regards to the energy sector, which used to have a big participation in the index, if I remember correctly, maybe a couple of decades ago, it was about 20%. We're looking at single digits participation right now.
Yes.
Do you believe that innovation in alternative energy will bring that weight within the index up over the next few years? Or, like I said, like you stated, sorry, in the beginning, will the innovators in energy be unsiloed or siloed in different sectors?
Well, you know, the history of disruptive innovation is the incumbents tend to lose out, except for a few of the biggest. The industry consolidates dramatically, and there are a few very big winners. So you can think just in the United States, Amazon disrupted retail enormously. And yet Walmart, which has scrambled to adapt, it bought jet.com and is actually become quite innovative. I mean, it's striking relationships, quite surprising relationships, like with TikTok. You know, I mean, who knew? This is the old Walmart. So they've imported the talent and have been fearful enough of losing their place in the retail world that they have transformed. So Walmart and Target and Costco would be the three big examples. In the banking space, we think it's going to be incredibly disrupted, but the consolidation will probably favor JP Morgan and a few others. JP Morgan in particular, while it's dragged its heels on Bitcoin, I guess Jamie Dimon's daughter finally got him to see the light, but they have actually come out and said, this is very healthy, we should have bought Square. We should be what Square is now. So that half of the solution is understanding the problem. A lot of incumbents think, nope, this is our installed base and they will come with us. They've been very loyal all these years, which is true. I think the average account holder in the United States, checking account holder, stays with a bank, I think it's some crazy number like 16 years. That is changing. That is changing. But because they were so comfortable, that had lasted for so long, they didn't change quickly enough. So there will be massive consolidation. I think the regional banks will be the big losers, and there are still 5,000 of them in the United States. So huge amount of disruption there. But typically, except for that, we usually say we prefer to be with the pure plays, and we are. We don't own those companies. Yet there are some examples in technology where they've been able to cross the chasm, and that is Autodesk and Adobe and Microsoft. Microsoft pivoted. Satya has done an amazing job when it comes to the cloud and artificial intelligence. And sure, his base business is mature, but he has those enterprises locked because he has been willing to change with the times.
And I think we want to touch up on some of the popular topics that we have in this part of the world, at least in Kuwait. Maybe we can talk about price targets, if I may. Most notably Tesla. We'll get to the digital currencies toward the end, and I think that's going to be an engaging conversation. But with regards to Tesla, your views, why Tesla versus the others? For me, it's always been confusing to find a company that's just starting out, being the size, in terms of market cap, the size of the entire automotive industry at one point. So please, maybe you can explain some of that to me.
Sure. And I'll just finish up on the renewables. We absolutely think it's ready for prime time. And when we get back to crypto, we'll give you an interesting link there too. We think that crypto is going to accelerate the shift towards renewables. So,
okay, it's a great link.
Yeah. So Tesla, what happened there? Well, I think what happened was, again, these auto companies hadn't changed in 100 years, and they didn't have to. They changed incrementally. So 100 years of success, changing incrementally. Why should they have changed? And here you get this upstart, this pipsqueak, this rebel, saying in the early days, I'm going to build my car on top of cell phone batteries. And mind you, cell phone batteries were blowing up on planes and were banned, right? In terms of cargo. So the auto industry laughed at him, and auto analysts laughed at him. And we took what he was doing and said, okay, let's see if we can figure out what the heck he's talking about here. And this comes down to that learning curve and cost decline, which is all important in innovation. What he effectively was doing, and no other auto manufacturer to date has done, even in their EV plans, is he was taking a technology that had been riding down a cost curve for years. It's called the consumer electronics industry. Think cell phones and laptops and, you know, anything, any electric device. And he basically said, I am going to build this car on top of a cost curve that has been falling for years. And I'm going to accelerate that decline with a new use case. And so that's what he did. He, with cylindrical batteries, lined the bottom of the car, whereas most other auto manufacturers were used to a form factor that had an engine where the engine is, underneath the front hood, right? And their form factor and their batteries were very different. Lithium ion pouch batteries, which were at a much higher cost point. Now, the slope of the cost decline is steeper than the consumer electronics now, because many consumer electronics batteries are in mature industries, right? Cell phone is fairly mature. We've added the new use case, electric vehicles, so it'll still go down, but not as steeply as the cost curve that other auto manufacturers. So we mapped out those two cost curves, and we said, okay, when will the traditional auto manufacturers with their battery technology become competitive with Tesla's? And we thought that was going to be in the early 20s, but because of the innovation around the battery pack system that Elon, putting silicon inside the anode of the battery and experimenting with other chemistries, we believe Tesla is still 3 years ahead of the traditional auto industry. So if you look at the 4 barriers to entry that we believe that Tesla has, the first is the battery. We still think they're 3 years ahead. The second is their AI chip. No one else is doing an AI chip. Tesla designed its own chip and took a leaf from Apple's playbook. This is very important. Why did Apple, the upstart in the cell phone market, why did it win the lion's share of the profits in that market? It saw the world a little differently. While Nokia, Motorola, and Ericsson were designing new phones with fashion in mind and form factor in mind, Apple said, wait a minute, this is going to be a computer in the pocket or pocketbook of the consumer. Consumers will be able to, and businesses will be able to access the internet through a smartphone. No one was thinking that in 2007 or 08. It designed its own chip, and it's taken the lion's share of the profits. Same thing with Tesla. Designed its own chip. No one else has done it. And then beyond that, the third barrier to entry is the amount of data it has accumulated with the robots riding around the roads. My Model 3 is one of them. They get data all day, every day. And then the fourth competitive advantage that they have had until very recently, some companies are starting to do this, is software as a service, transportation as a service. I have never, my Model 3, I bought it in 2018. I've never had to take it into the shop. The Tesla has anticipated the problems in my car before I ever identified them or the car ever. So I've never taken it in. The one exception has been a nail in the tire, which of course software can't fix. So I don't count that, but just think about it. I've never, when I told actually my trainer this, he's been debating about a Tesla. When I told him that, he went out and bought a Tesla because maintenance is such a big problem with these complicated gas-powered cars.
Is it too late for companies to catch up to Tesla? So, I mean, they come with big arsenals of cash that they can throw at the problem. They've tried for decades. But maybe now it's time. They do have the data. They do have the know-how. We've seen the launch of a competitor, F-150 from Ford. The other issue is, can China make them cheaper for the mass public? Are these threats to companies such as Tesla?
So there will be different competitive dynamics. They will not be able to beat Tesla on technology for years. So in other words, they may choose to, from a performance point of view, think the Mustang, they may choose to maximize its ability to go from 0 to 60 miles per hour. They have to fake the sound that people love, but they may be able to do that, but it will be at the expense of range. So there's a performance range trade-off. None of them will be able to price as low as Tesla for like cars, same performance range. No one will be able to price below Tesla. In China, the pricing will be at some sacrifice. It will be either range or performance or both. So, you know, it really depends what kind. So these companies, the F-150 is a very good example. Will the Cybertruck work? Well, F-150 has certainly gotten off to a nice start. And I know a lot of people who say they would not buy a Cybertruck, but they will buy an F-150. So I think Tesla is going to have to, is really going to have to compete there on performance, because that's what from what I can see, what customers want. So they'll be able to use their brands and their legacy, nostalgia. What does this car mean? A Mustang. My first car was a Mustang. I have a very fond spot for Mustangs. I'm not going to buy an electric Mustang because that's, to me, not the same thing, but to others it will be.
And with regards to, and I know we're running out of time, so I want to cover a lot, maybe a couple of topics before we get into digital currencies, which is the exciting part. But with regards to valuations of Tesla and others in the market right now, or the valuation of the overall market, is it a consequence of the constituents? Or is this the new norm that the companies of the new age demand a very high multiple, and we should get used to these? Well, now they're historically high valuations.
Yes. So the time frame is important here. We have a 5-year investment time horizon. And so when we are valuing a company in year 5, what we're doing is applying a multiple to it, like a FANG stock, you know, roughly 17, 18 times EBITDA. This is not for every category. It depends on what, in genome, we're not going to do that because many of these companies will still be in their infancy at that point. But we do apply a mature FANG multiple to most of the names in our portfolio in year 5, even though we think they will not be mature. In fact, they will still be ramping up the S curve. So from that point of view, we think we are fairly conservative in our valuations. We want our companies to be investing aggressively right now and to forego short-term profits in order to capitalize on some of these winner-take-most opportunities. And we think autonomous taxi networks will submit to natural geographic monopolies. And so those who invest the most aggressively now in artificial intelligence, data collection, robotics expertise, software as a service expertise, and of course, battery technology are going to be the winners. We think Tesla is the winner in the United States. That's our bet. We are taking a close look at cruise automation, which GM owns, Waymo, Google, and so forth. From what we can see, what we can discern, we think that Tesla is still in the pole position. So to get to our base price in Tesla, the 3,000, and you can see our modeling on GitHub. So you can see exactly, and you can experiment with the variables that we think matter to battle test our assumptions and price targets. So that 3,000 assumes that Tesla keeps its roughly 20% market share globally. We used to think it would go down to 11% as some of the new the traditional automakers ramped, but it took them too long, and so that probability. The probability that Tesla's share would decline, we think that probability has gone down because it's still the innovator in the space, and it's Tesla's to lose, we think. It's also based on gross profit margins on the EV side of roughly 30%, maybe a little north of 30%, whereas the bull case is on 40%. And it assumes there's a 50% shot that it gets autonomous right and does develop a commanding lead in the US, if not elsewhere. So that's our $3,000 price target. The stock is, I guess it's closing in on $700 once again. So that's a healthy return over, I think it's north of 60% compound annual rate of return in the next 5 years. And our minimum hurdle rate of return is 15%. If you looked at our portfolios on February 12th, which was the peak of our performance, certainly relatively, that for the flagship portfolio, our expectation based on our price targets was that it would have delivered a 15% compound annual rate of return. That's our minimum. We get a little uncomfortable when it gets that low. Today, that number is closer to 25%. So instead of a doubling over 5 years, a tripling over 5 years.
Wow, that's amazing. And maybe Cathie, we could jump into the most interesting subject right now, which is digital currencies. I want to know what your view is. Is it only Bitcoin, or are you looking at other options as well in the digital currency space?
Yeah. So just from a high level and backing up a bit, when the internet was conceived, commerce wasn't even a thought. In fact, consumers in the US could not use the internet legally until 1991. When we passed a Telecommunications Act. I was surprised to hear, Steve Case reminded me of that when he gave a presentation about a year ago. And so the payments part of the commerce platform was never built into the internet from the beginning, from the get-go. No one thought commerce would take place and so what happened is commerce evolved with traditional credit cards, debit cards, and so forth. Now we are seeing the payments platform, the financial services infrastructure being built into the ecosystem. It's called DeFi, decentralized finance, thanks to blockchain technology. And we do believe, we're not a Bitcoin maximalist firm at all. I know that Yassine El-Mandra, who hails from Morocco, he came into the firm fresh from school, the University of Pennsylvania, and seemed a little bit maximalist to me. But we have gotten through that. And now we also have investments in Ether and ETH, which is the grayscale version of it, in certain of our portfolios that will allow it. And Ether, of course, or Ethereum is the platform upon which most of DeFi is taking place, as well as stable coins and NFTs. So we see Bitcoin as the first truly digital global currency, but it is more than that. It is the first global monetary system. And my mentor and now friend, Art Laffer, who was educated by Robert Mundell, who won the Nobel Prize in Economics for global monetary theory, we took him through our first white paper on Bitcoin. This was in 15. And we were simply saying, could Bitcoin serve the three roles of money: means of exchange, store of value, unit of account? The paper's still on our site. And he tore our paper up. He's an economist. He was not going to put his name to anything that didn't meet his standards in terms of monetary theory. And we ended up, I said, just to give you a sense of how profound this was in 2015, I said, Art, how big could this become? And he said, and at that time, Bitcoin was $6 billion in market cap. Today, it's probably 750 billion. I said, Art, how big could this become? And he said, well, how big is the US monetary base? And at that time, it was $4.5 trillion. And today, it's 8 trillion. So that was his first answer. And that only has to do with its reserve currency role, which it is. It's the reserve currency of the crypto asset ecosystem. But there are other use cases. And we believe that ultimately everybody, every high net worth individual will take out at least 5% or put 5% of his or her assets in crypto, probably Bitcoin getting the lion's share because it is the most secure network. It is the most secure network, bar none. Ethereum has been built primarily on GPUs, not ASICs like the Bitcoin blockchain. So for DeFi, it's fine. For, you put up collateral. There are a lot of safety measures on it. But for network safety, pure and simple, where you want that insurance policy, Bitcoin is probably going to get it.
Now, Cathie, with regards to Bitcoin, you're speaking to a person that is believing, in the process of believing, and hasn't crossed that threshold into a complete believer. The preventative factor has always been the regulatory evolution surrounding digital currencies. What are your thoughts around that risk?
This is an example of regulation elsewhere giving some parts of the world a competitive advantage to the US. The US has, I think, 6 financial regulators, and they're all tied up in knots. They don't agree. The IRS considers it property. The SEC considers it not a security. CFTC considers it a commodity. So, and in Europe, Switzerland, the UK, much less regulatory bureaucracy.
Most notably China. China was the most notable action recently.
Yes. And what I fear China is doing from a Chinese point of view is Xing itself out of a global movement, a global technology movement. This is an open source technology movement. And China is saying no. And the reason it's saying that is this is all about capital controls. And we're seeing today, there was something we were discussing. Yes, companies deciding not to list on Starboard, the Shanghai exchange. Anyone with a financial bent is choosing to list elsewhere. They're choosing actually to come off Starboard. So I think China is it's going to be a big market for its own coin, but that's internal to China. And I'm not sure how big it'll be in Southeast Asia. I know they're trying to evolve so that the yuan becomes the reserve currency of Asia. That's an attempt. I'm not sure people will trust that even in Southeast Asia. We shall see. I think that regulatory, we are sorting things out. The US is, I think, gone about it. It's been very difficult, but we're beginning to see with Gary Gensler now at the SEC, we know the research people within the SEC, they know what they're talking about. And in fact, they're now being invited to other countries in the world to share knowledge, share ideas about the best way to regulate. So I don't think regulators want to be blamed for preventing their countries from participating in the next big thing, the next big technology, and particularly in the United States. And I noticed that early on when I sat in with a group of regulators, and I could see how tentative they were. They didn't want to be blamed.
But it seems like central bankers want to step in with a digital dollar or a digital currency for their respective central bank. Is that a threat as well?
Sure. I don't think it's a threat. I think that's a good opportunity to bring more efficiencies into the ecosystems around the world, but they're going to still be governed by human beings, unlike Bitcoin, right? These are going to be tethered to fiat currencies, and therefore the monetary policy associated with those fiat policies is going to determine how well these stable coins maintain their purchasing power. Bitcoin is designed with that one purpose in mind. There are no human beings. It's mathematically metered to top out at 21 million units, and we're over 18 million units right now. So its store of value role, I think, is its strongest proposition right now. We are seeing with third-party applications built on top of Bitcoin, that we may see means of exchange become more popular, but they're still working the kinks out there.
And the topic of storage of wealth, how can we consider an asset as a means to store wealth when we've seen half of it destroyed virtually in a matter of months? So the concept of storage of wealth with an asset that drops 50% seems mind-boggling to a lot of us.
Well, last September, it was at $10,000 to $12,000. So we're not even a year, and we're triple that. So really, endpoint sensitivity matters here. And I do think this is right now very, very new to a lot of people. You have a lot of hedge funds, a lot of traders. They're chart watchers. So be prepared. If it breaks moving averages, then it's going down lower until they feel that it's gone down. So you have to be prepared for that. And what we do is we wait. We lie in wait for those opportunities when there's a freak out, and that was a freak out, of course. And we bulk up then. Just know it's going to happen, and that over time, if we're right on how important Bitcoin will become as the crypto world's reserve currency, then it will continue to appreciate, and its purchasing power will go up, unlike fiat currency.
Now, Cathie, we've reached the end of the hour, but maybe just for the sake of our audiences, could you give us the good graces of your price target on Bitcoin?
Yes, well, with very few use cases, we can see it at $500,000. And we get there any of a number of ways, but one of the ways is institutional asset managers are moving in now, and they have to have a point of view, because crypto assets are the first new asset class since the 1600s, since equities. And the correlation of relative returns, just take Bitcoin to all other assets, very low. The biggest or the highest correlation is to real estate, 0.34, right, vis-a-vis Bitcoin. So institutions, they have to have a point of view on this new asset class. And we do believe, just like real estate in the 70s and 80s, and then emerging markets in the 80s and 90s, even though that was not technically a new asset class, they started out with 1-2% positions, moved to 5%, and at 5% of institutions around the world allocated 5%, and let's just say it were towards Bitcoin, that use case alone would get us to $500,000.
Excellent, excellent. So, Cathie, I think, and we've taken up a lot of your time, and I hope the audience has enjoyed what we were able to deliver to them. And in conclusion, I would like to thank you, Cathie, for making yourself available for this very insightful engagement. It's always a great opportunity for us at Kamco Invest to share with our investors and audience the level of access that we maintain and develop on behalf of our clients and various stakeholders. We're constantly exploring opportunities across asset classes, markets, and niche strategies to deliver the level of risk-adjusted returns that our investors expect from us. ARK Invest and Nikko Asset Management are a testament to the level of quality and sophistication that we demand on behalf of our clients. This is how we remain competitive across our products and services regionally and globally. We're consistently ranked among the top performers regionally through our products, and we are consistently investing in the best of breed managers, such as yourselves and others. Whether through our brokerage arm, Ul Al-Wasata, or our recently developed international online trading platform, our clients are able to access such highly acclaimed opportunities with proven track records, such as ARK, that are listed across global exchanges. We also provide custom-tailored portfolio services to clients that demand competitive access and diversification to meet their investment objective, return targets, and exposures. Cathie, thank you so much. And the team behind you, obviously, please thank them for us. Nikko Asset Managers for assisting us in this. And obviously the team at Kamco for working so hard. We really thank you for your time, and good luck with your newly launched Bitcoin tracking ETF. We wish you the best.
Thank you. Thank you. It was our honor and pleasure. Thank you so much, Faisal.
Thank you. And good night, everybody. Thank you.
Bye.